Good afternoon, everyone. My name is Jeff Feinstein, Managing Director, Managing Partner at Pinnacle Partners. Thank you for joining us on another installment of our Thought Leadership series as we talk about all sorts of investing strategies, typically involving opportunity zones, but also business sales, concentrated stock position sales. That has been the ongoing theme of our Thought Leadership series. More recently, we described to our audience the OZ 2.0 framework, the new permanent provisions established in the BBB. We also talked about how the BBB, broadly speaking, can impact positively real estate investing strategies. This is a continuation of that discussion. I would consider this more of a practicum where we have yet another thought leader, which I'll introduce in a moment. But we'll talk about very specific strategies on how to optimize realized gains in 2025 and 2026 for OZ 1.0 deployment and execution, and potential strategies for structuring 2026 gains to be in position to take full advantage of OZ 2.0. And so joining me today is a friend and colleague, Ryan Mark, tax principal at HCVT in the California office. Ryan and myself and our two firms have collaborated previously with mutual clients. And HCVT, in my opinion, has been out front in advocating legislation and policy influence as OZ 2.0 was being derived and ultimately through the bipartisan and ultimately a ratification process. So Ryan, thank you for joining us. We're glad you're here today.
Thank you, Jeff. I appreciate that. And yeah, to tell your listeners a little bit more about HCVT,
Please.
I am in our headquarters, which is in West Los Angeles, but we have offices in Utah, Arizona, Texas, and California. Firm of about 850 people. Our OZ team was started right back in the beginning of the OZ program in 2017. I joined shortly after in 2018 and have been working with the OZ team ever since. We have consulted on probably 500 or so gain deferrals through opportunity zone funds, or what we call our captive opportunity zone funds for individuals that want to direct their own investments. We prepare probably 200 of those opportunity zone funds. Our OZ team, as you can see here, has two partners, multiple principals and managers, and we're up to about 15 staff within the OZ team.
Wow, quite impressive. One of the largest practices I've been aware of. And as I said earlier, the entire team has been providing really interesting commentary as the legislation was moving through passage, and now opining on a variety of strategies. So again, today, understanding the audience will presume at the moment understand 1.0, which we'll review very quickly here on this slide, and 2.0. But let's talk about some ways to optimize execution and investment in either program. So we're going to walk through these slides. I'll interject with some questions, but thank you, Ryan, for providing this valuable information here. It's action.
Yeah, of course. Yeah, OZ 1.0, as we know, offers deferrals of gains until 12/31/2026. Previously, there had been some speculation about that being extended to 12/31/2028, but as you've talked through the BBB, the ultimate plan was that it came out into a permanent program that now offers rolling 5-year deferrals. OZ 1.0 applies to all gains, just like 2.0. That's one thing we like to point out. People always ask the question, does my 1250 gain qualify? Yes. Does my short-term gain qualify? Yes. It doesn't have to be at the long-term tax rates. With OZ 2.0 coming up, we do like to point out that OZ 1.0 still has about a year to an 18-month deferral. There are a lot of opportunities to minimize the tax hit of a gain today by pushing out that realization until 12/31/2026. Not only do you get to hang on to the tax amount and invest that over the course of the next year and a half, but you also can explore other opportunities such as lost harvesting that you may not have had time to complete by the end of this year. You'll have an entire additional year to structure your lost harvesting or other tax strategies to mitigate some of the gain that you would have otherwise paid tax on this year.
So if I may interject here, Ryan, so I think what you're advocating that I have $1 million gain. I know I'm going to pay 23.8% April 15th of 2027, right? Realized in 26. And are you suggesting a set aside of that $238,000 into treasuries, something safe, with a little bit of premium paid, and then invest the delta balance of the gain?
Right. You can, I mean, within the opportunity zone structure and the way we set up our captive opportunity zones with a QOF and QOZB, there's actually a lot of flexibility in terms of what you can do with the money in the interim while you are trying to execute your working capital safe harbor business plan. And that really allows you to make a pretty wide variety of investments. Yes, you could do safe things like treasuries, but there are also no restrictions on loaning the money from the QOZB to a related entity. And there's also protections on the type of assets that the QOZB holds while it is executing its strategy. So we've structured quite a few QOZBs that hold, stock, bond, and other investments during the working capital safe harbor period so that the investors can really maximize their returns while they are finding the right OZ project to deploy their money into.
Right. In a captive QOF scenario, if one of your clients was to invest in our QOFs, they wouldn't have that latitude per se, but they certainly could, as I suggest, invest in treasuries, that whatever amount they want to set aside for the deferred tax payment due
Right.
April 15th to 27. Okay, understood.
Yeah. And as you mentioned, 2025 gains, if you've already realized gains this year, or if you are, approaching a sale that you're not controlling the timing of, OZ 1.0 is going to be your best and only option, really. The only gains that are going to possibly qualify for OZ 2.0 will have to be realized no earlier than January 1st of 2026, no later than January 1st of 2026. So any gains coming up now, OZ 1.0 is great. If you already have a qualified opportunity fund or know a qualified opportunity fund that you want to invest in, great option. If not, HCVT can set them up. And a lot of times when we set up the qualified opportunity fund in QOZB, it is just to buy the investor time to find the right option. That's one of the tricky parts of the program is that a lot of times you're realizing a gain and you haven't thought about OZ before and your tax advisor tells you about it. And then all of a sudden you're like, well, where do I even invest, right? There's requirements as to where the OZ money goes. And so a lot of times investors have needed a year or two to find what they want to invest in, do their due diligence on funds, talk to people, meet people. And so we have set up qualified funds specifically for the purpose of just deferring the gain, getting them into the program, and then allowing them the time to find the right investment that they want to make.
Yeah, in my experience here, and of course, we have together, HCVT and Pinnacle Partners have collaborated on a captive QOF. Let's just say it was organized and we accommodated that QOF into our QOZB so that QOF could come straight into our investments at the QOZB level. A little bit technical, I know. By allowing that, you preserve all your tax benefits, your 10-year clock, etc.
Right.
And so we did this together in partnership to serve the needs of a client. My experience has been, so Pinnacle, by the way, has these flexible structures to accommodate captive QOFs. My experience has been that the individuals, as you described, they require more time. Generally, a large gain has been realized, could be business sale, large real estate sale, or they're potentially desirous of it being self-directed. right? That is to find their own opportunity, execute on that, and maybe manage that opportunity themselves. So those are the types of individuals I've seen that have utilized the captive QOF, which
Yeah.
HCVT probably is the market leader in deriving these QOFs.
And that's a really good point. Not everyone is flexible enough to take the money into the QOZB level, but generally that is the best structure for these individuals who have set up the captive QOZB, who then want to invest in a fund. The easiest methodology is for them to move their money back to the QOF and then invest from their QOF into the fund's QOZB to preserve all the benefits. In very rare cases, we have been able to do somewhat more complex partnership transactions, such as QOF mergers, which are they can work out as well, but it's definitely, as you mentioned, even bringing money into a QOZB is complex, and then QOF merger can take the complexity up a notch as well. So it's not an easy transaction, but there is a lot of flexibility to get things accomplished within the OZ world.
Excellent. And before we leave OZ 1.0, and I think you very clearly articulated, the timestamp here, the time duration remaining for the program, 18 months. Talked about some strategies of investing, partial gain, and preserving, so to speak, the deferred tax in a risk-free instrument. But Ryan, can you give us your opinion of two things that our investors have asked more recently? Number one, short deferral period, but is that, do you consider that de minimis, or is that material? The fact that the deferral is now shortened. I've heard, many practitioners describe the imputed value of these three benefits, right? So there's deferral, use of depreciation without recapture, and qualifying for tax exemption. That is no tax on the appreciation of the underlying real estate. That the bigger benefits, if that's kind of 400 to 600 basis points, the biggest benefits are use of depreciation without recapture and tax exemption. So do you want to speak about, oh, well, there's limited deferral period, so therefore I might pass on 1.0. What's your opinion on that particular concern?
I mean, in my line of work, I feel like individuals want to kick tax down the road as much as they possibly can, even if it's only a year. I mean, we do a lot of things that defer either income recognition or taxes a year. I still think a year is a material deferral. The OZ program, I think a lot of people thought that the investments were going to be riskier than they really were because of the low income nature of the areas. But over the course of the years that we've been doing this, we've found that the areas really did benefit from the redevelopment. And I think a lot more investments worked out way better than what we were anticipating. So I don't think there's a significant risk in terms of, setting this up to get the year deferral. And as you mentioned, the real benefit is the tax-free depreciation and appreciation. If you really are a long-term investor who's wanting to spend the 10 years, it is potentially a huge benefit to take all that depreciation over the life of the investment against ordinary income, right? You're going to take that depreciation at high tax rates. You would normally recapture it at a high tax rate. Here it goes away. So you're getting the highest tax rate benefit and then not recapturing anything. And then your appreciation, which would normally be at a long-term capital gains tax rate, also goes away. And who knows what the long-term capital gains tax rate will be 10 years from now. There's been discussion every once in a while about increasing that rate. And in the OZ world, that wouldn't hurt you.
Right. And just to reinforce the point on deferral, I look at it, tax-free, or excuse me, interest-free loan from the IRS, right? Like, okay, you get to use that money as you wish for a year. We just discussed that. Two, you get to establish basis at the pre-tax value, potentially, in the new OZ investment. And then three, something you raised earlier in the discussion, you have a year, if you wish, to harvest losses and offset gain, if you
Yeah,
choose in 26. So still a lot of value in the deferral period, to your point.
right. And there's not, it's not hugely complex
Hmm.
to achieve the deferral. As I mentioned, we've done hundreds of these. Um, and while there is a cost, of course, to establishing it, it's not that complex, and we can get it done. And
Hmm.
I think it's easier than a 1031 exchange, so it's a good
Yep.
way to go with the deferral.
And then final comment on 1.0, and we'll move on to 2.0 is, and correct me if I'm wrong, this is a question really. If you invest in 1.0, it's possible you could also take advantage of bonus depreciation allowed in the BBB after January 17th. Is that correct?
Yeah,
It's January 9th.
yeah, January 17th, 2025. So it
Okay, January
applies to
7th.
assets purchased this year.
Mm,
Um, and yes, that's another great benefit, is that we can combine the 100% bonus depreciation on the new assets acquired. And often with our OZ projects that have started to reach completion, we highly, highly recommend cost segregation studies if it's a real estate project, because those will really maximize the benefits bonus depreciation and get a lot of upfront deductions. In order to benefit those deductions, the fund and QOZB typically does require debt to be within the fund in order to benefit from the deductions immediately.
mhm.
Otherwise, your fund typically restores its basis 12/31/2026 when the gain is realized. And you benefit from the deductions at that point when you have the basis to do so.
Okay. Excellent. Thank you. Well, I think we've covered 1.0 really well, and HCVT again, just being, so committed with 15 practitioners to executing on the OZ legislation better than most. I think now is going to offer some really interesting ideas for those with planned sales in 26. So Ryan, please share.
Yeah, so OZ 2.0, as many know, begins January 1st, 2027. In order for a gain to qualify under the OZ 2.0 deferral, the 180-day reinvestment window would need to cover at least January 1st, 2027. There's multiple ways to achieve that, because under the regulations, the 180-day window can begin at different times depending on the structuring of the gain. So an individual selling a stock will have a strict 180 days from the date of sale. So if an individual doesn't need to sell the stock today, you'd have to wait until the second half of 2026 and sell the stock within 180 days prior to January 1st, 2027, so that you'd have January 1st within your 180-day window and you can reinvest.
So
Gains
just,
that, oh, go ahead.
if I may, just to clarify, so if I trade NVIDIA, I'm going to choose a date, September 1 of 26. I can exhaust my 180 so that I get past Jan 1 of 27 and I qualify for OZ 2.0 benefits. Is that correct?
That's correct.
Okay. Okay. Well,
Yeah.
that's
So in the 180 days before January 1, if you have a direct stock sale, you can wait until 2027,
mhm,
reinvest in an OZ, and hit the 2.0. For a gain that is flowing to an individual on a partnership or S corporation K1, you can elect to use the year end or partnership due date, the return due date of that return that realized the gain, to begin your 180-day window. What that means is, if the asset that's being sold is held in a flow-through entity and it's sold in 2026, any point in 2026, you're going to be able to make it into 2.0, because you could elect to use, for a calendar year partnership, for example, you could elect to use the year-end date of 12/31/26 or the partnership due date of 3/15/2027 to begin your 180-day windows, which means you'd have all the way until September of 2027 to reinvest 2026 partnership gains.
This is really important. Now, this applies to 1.0 today. And so there are three different timestamps in which the 180-day clock begins, either the date of the transaction, as Ryan said, or 12/31 of that year, or March 15th of the following year,
Correct.
which allows tremendous flexibility. Question, Ryan, I choose for any reason, I can't derive a particular reason at the moment, but I choose 3/15/2027 as the start of my clock. Then I must invest on March 16th of 27, or can I go and retroactively invest something earlier than March 15th?
If you choose the 3/15 date, then you have to invest 3/16 between 3/16 and about September 12th. Now, when I say choose the date, there's no form of election in terms of which date you're choosing. And so because the 12/31 year end date and the 3/15 180-day windows overlap, we generally say if you have a partnership gain, you've got from the end of the year to September of 2027 to reinvest. The only time the 180-day or the choice would matter is if you're deferring multiple gains. Once you've put one gain in, for example, if you put money in between 12/31/2026 and 3/15/2027, you've elected to use the year-end date by making that funding. Now your 180-day window runs from 12/31/2026 to, June 30th or whatever the 180 days would be from then. And so it would be important if you're making additional investments, if you're funding over time rather than funding all in one lump sum.
And I'm just generally curious, Ryan, if I'm a small business owner and maybe I've sold the business and I'm going to claim 12/31/26. I'm committed to OZ investing. I'm expecting a 5-year deferral. I assume then you don't advise your clients, and you can caveat this for sure. You don't advise your clients to impute that gain as part of the estimated tax payments.
Correct. Generally, we tell our taxpayers, if you know you're going to do it, then we'll operate under the assumption that that gain is deferred. We don't make any estimated tax payments. We wouldn't make an extension payment. We do just tell people, if you for some reason get cold feet and change your mind, you're going to be subject to penalties for not making these payments.
Or you could pay it and then get a refund, but nobody really likes to do that.
Yeah, generally, I mean, if a taxpayer is really, really on the fence about doing it, then maybe pay and get the refund once you've confirmed that you're going to do it. But generally, we just don't pay if we know the individual is going to fund the QOF in the future.
And in your third bullet here, you're listing some ways in which you can, I guess, obtain more flexibility. Installment sales being one, right? So I get an earnout, or I've sold my business. I'll take it in 3 lump sum payments over 18 months or something like that. The receipt of each payment is then its own realized capital gain. Is that assuming it is a capital gain?
Yes, that is correct. So, and I know I don't have it listed here, but because we were talking about partnerships, that's kind of our first strategy is if you're sitting on 2025 appreciated assets already that you have flexibility in terms of when you're going to sell them, but you want to sell as early as possible, one thing we've been talking about is contributing those assets to a partnership. Now, get them contributed to a partnership in 2025. That way, January 1 of 2026, you could sell. And now you've got your gain flowing on a K1 rather than to you personally. So you could potentially exit whatever the position is 6 months sooner than had you not had that asset in a partnership. So that's one.
Very interesting.
So that's one. And,
right?
And generally, contributions to partnerships are tax-free under 721. So you're not going to create a tax consequence to yourself this year by putting the assets into a partnership, and you'll allow yourself to sell a little earlier in 2026 and still get into OZ 2.0. Next one, as we mentioned, is the installment sales. The downside to that, obviously, is you're deferring the receipt of cash on whatever it is that you're selling. But if you're entering into a transaction that has to be entered into and you want to close now, but it's important to you to get into OZ 2.0, installment sale is a great way to accomplish that, because you can push the receipt of the subsequent payments back to where they would qualify to OZ 2.0. OZ 2.0 is also reinstating the 10% haircut on the gain that you invest as long as you hold for 5 years. So there's some exclusion of the deferred gain as well by doing that.
Let's just make that point crystal clear. The new OZ 2.0 program reinstates the so-called 10% step up. People sometimes get confused, the terminology. That's effectively a discount on your deferred tax due. Instead of, in my prior example, 238, you take and pay 90% of that, not 100% of that.
Correct. And that's going to be always achievable in 2.0. One of the oddities of 1.0 is once the period before 2026 was less than 5 years, that 10% was not achievable anymore. It just kind of went away as a benefit. But now with the rolling 5-year deferral, as long as you hold from 5 years, you will always be able to achieve your 10%, no matter when you invest in the OZ program. We mentioned 1031 exchanges and Delaware statutory trusts. Delaware statutory trusts, that's something that, it's a little, there's been some IRS scrutiny of those, but they're generally like a 1031 exchange, but with a diverse asset portfolio. The reason why we mention 1031 exchanges with respect to opportunity zone deferrals is you can use opportunity zone as essentially a safety net for failed 1031 exchanges, because 1031 exchanges, you have a replacement criteria within 180 days. If you are not able to replace within 180 days, your gain then becomes realized at that point. And so
interesting.
You then have a new realization date 180 days later, which then gives you another 180 days to go into an opportunity zone fund and defer the gain.
Interesting. That's clever. And so to be specific again for our audience, 1031 DST is applied only to real estate sales.
Correct.
Not stock sales, crypto sales, short-term sales of realized capital gains.
And that also defers the receipt of cash, of course, because with a 1031, the money does not go to you. It has to go to an accommodator. So you're kind of pushing the receipt of your cash out, but you could potentially, get into OZ 2.0 territory if you are unable to find 1031 replacement property within the 180 days.
And just to demystify the concept here, if you want to disentangle from a intermediary in a proposed 1031, that's not that difficult, is it?
No. As soon as you take the cash out, the 1031 ends.
Yeah, understood. Okay.
So.
Excellent. Very, very good idea.
So as we move into OZ, the other thing that we have to consider is OZ 2.0 will come with all new census tracts. The requirements are a little stricter. And so I think it's estimated that there will be 7,500 qualified OZ census tracts rather than the 8,700 that there were in OZ 1.0. And a certain
That's because of the reduction of AMI, correct?
Correct.
80% to 70% of AMI.
Yeah, that income threshold cuts some out. And then a portion of those census tracts are now going to be rural, which is defined as 50,000 of population or less that is not directly adjacent to a major city. So that's also going to carve some of the census tracts out into much smaller population centers. So one of the benefits of OZ 1.0 is, you're potentially coming into census tracts that are pretty well into their development. OZ 2.0, you're going to be back to the brand new census tracts with a little more uncertainty, I guess.
Very good.
The rural tracks will come with additional benefits, a 30% basis bump rather than 10 or haircut. So you'll only pay 70% of your deferred gain. And the requirements of qualifying within the rural OZ areas are relaxed.
That's right.
So I think we already talked about this, just controlling the timing of gain to get into OZ 2.0.
Yep.
One last thing that I'd like to talk about that I feel like hasn't been talked about much yet, but it's going to become very important over the next 18 months or as we get closer to 12/31/2026 is the regulations under both OZ 1.0 and 2.0 do specify that the deferred gain realized on 12/31/2026 or at the end of the 5-year period in 2.0 is limited to the lesser of the original deferred gain or the fair market value of the OZ investment on the date of realization. So something that hasn't come up a lot that we think is going to be particularly important in 12/31/2026, especially as we start thinking about these later OZ 1.0 investments that are not going to be completed by 12/31/2026, is there's the potential for substantial discount of fair market value at that valuation date specifically, because we think that, you know, a half complete real estate project is not going to be as valuable as maybe the initial investment until stabilization. So by taking advantage of discounting similar to estate planning with lack of control discounts, lack of marketability discounts, and other discounts, we think, you know, a 30% plus discount is not going to be unreasonable on these. And so a taxpayer who invested and maybe doesn't qualify for the 10% haircut could still shelter a significant portion of their gain by getting a detailed valuation on 12/31/2026 of the QOF interest.
This is very, very interesting. Has certainly captured our attention for the purposes of our QOFs and underlying. Again, a very creative solution. Thank you for sharing that, Ryan.
Yeah, I think that'll be popular.
I think you're right. Any final comments here before we wrap up?
Just, you know, in conclusion, I think that the OZ program is still probably one of the most attractive tax deferral strategies right now for most capital gains, and a really powerful tool to grow potentially very large tax-free assets. There's opportunities for estate planning with this as well. Disregarded entities such as trusts can invest in qualified opportunity funds and create OZ investments, while the original owner of the disregarded trust is the one who defers the gain and ultimately pays the tax when the gain is realized in 12/31/2026. So it can be a good estate planning tool too, to get appreciated assets out of your estate now, have the individual pay the tax on the gain, and yet have the gross amount in the trust to grow and potentially be tax-free.
That's right.
So
very, very interesting. Any other closing comments here? Didn't mean to interrupt.
I think that's everything I've got. I just appreciate the time. It's always great talking to you. Great working with you, and I hope we continue to grow the OZ program.
Absolutely, and we will together. Well, thank you, Ryan. This has been outstanding, timely content, actionable content. A quick reminder, Pinnacle Partners is a source of high-quality opportunity zone funds and underlying projects. We work closely with HCVT, as discussed previously. Ryan, why don't you share your contact details, please, so people can get a hold of you? I'm sure they have some questions. There we are. Excellent.
So I'm the third one there, down there on the left, ryan.mark@hcvt.com. that will go directly to me. My phone number is there on the screen. You can also email ozteam@hcvt.com if you want to reach the team as a whole.
Excellent. Ryan, thank you so much. Very valuable content. We look forward to our audience returning for another installment of the Thought Leadership Series. This one was very impactful. Thank you, everyone. Have a great rest of the day.